Have you ever just stared at a market profile chart and seen nothing but a jumble of letters? You are not alone. That's what the auto setting gives you most of the time, just pure noise. But what if you could actually tame that chaos? Well, today, we're going to show you a professional, volatility-based method that transforms that mess into a crystal clear picture of what the market is trying to do.
Okay, let's just dive right in because this single image really says it all. On the left, that's your typical auto setting chart. It's stretched out, it's compressed. It's basically unreadable. But on the right, that's the exact same data. The only difference is it's structured with a volatility-adjusted method. Suddenly, it's clean, it's organized, and it tells a story you can actually trade.
So, the question is pretty obvious, right? Which one would you rather be looking at when your money's on the line? And look, this isn't just about making things look pretty. Clarity leads to better analysis, and better analysis is what gives you an edge. The chart on the right, that's where you find the clarity.
So here's the fundamental problem we're trying to solve. Auto mode is a one-size-fits-all guess in a market that is changing by the second. It just doesn't work. The solution is to take back control. We're going to use a systematic approach that adjusts your TPO settings. Think of those as the building blocks of the profile, based on a market's actual current volatility.
So, how do we measure that volatility? Well, our main tool for the job is the average true range, or ATR. Now, don't let that technical definition on the slide scare you off. All you need to know is that ATR is like the market's heartbeat. It tells us, on average, how much an asset is moving. It's the tuning fork we're going to use to get our charts perfectly in sync with the market's rhythm.
All right, let's get practical. In this first section, we're going to walk through, step by step, exactly how to calculate your TPO block size. This is the absolute foundation for building that clean, structured chart we're aiming for.
And honestly, it's a really straightforward three-step process. First, we need to grab the right ATR value. Second, we're going to do a quick bit of rounding just to clean up the number. And third, we apply a super simple formula to get our final block size. Let's break down each one.
Now, here's what's so great about this method. It adapts to your trading style. The source for your ATR simply depends on your time frame. So if you're an intraday trader, you're going to use the volatility from the daily chart. If you're a swing trader looking at a weekly profile, you use the weekly ATR. It's all about matching the tool to the job you're doing. Step 2 is just about as easy as it gets. We're just rounding that ATR value we found to make it a cleaner number for our settings. So, for example, if the ATR for Bitcoin is, say, 3,444, we just round that up to a nice even 3,500. If it were 12, we'd round it down to 10. Simple as that.
And this table here is the final piece of the puzzle. You see, every instrument moves in different increments. That's what we call the tick size. So just think of this table as your decoder ring. You find your instrument's tick size on the left, and it tells you the exact, simple formula to apply to your rounded ATR. Now, this specific table is set for the Indian market, but the principle is universal. The final calculation is always tailored to the specific instrument you're trading.
Okay, so our chart is now perfectly calibrated to the market's volatility. Awesome. But a clean chart is just the start, right? Now we can actually use it for analysis. And that brings us to section 2. Where we're going to explore one of the most powerful concepts in day trading, reading the initial balance. The initial balance, or IB, it's just the high and low of the first hour of trading, but don't let that simplicity fool you. Think of that first hour as the opening scene of a movie. It sets the entire tone and gives you these powerful clues about how the rest of the story, the rest of the trading day, is probably going to unfold. So how do we actually interpret those clues? Well, we use another really simple but powerful formula. We just take a shorter-term, 10-period ATR from the daily chart and divide it by 3. This single number, our IB range factor, is the key that unlocks our understanding of what kind of day we're in for. So once we have our IB range factor, we use it to create 3 distinct categories for that opening range. Is it narrow, moderate, or wide? See, this isn't about guesswork or a gut feeling. It's a systematic way to classify the market's opening strength based on its own recent volatility. Let's make this super concrete with a quick example. Imagine the daily 10-period ATR for whatever you're trading is 225 points. Okay, we plug that into our formula, 225 divided by 3, and that gives us an IB range factor of 75. Easy enough. And now, with that factor of 75, our zones for the day are totally locked in. If the actual range of that first hour is 75 points or less, boom, we call it a narrow IB.
If it's between 76 and 150, it's moderate, and anything over 150 points is a wide IB day. And just like that, we've turned ambiguity into a clear, data-driven framework.
And this, my friends, is where it all pays off. We've set up the chart, we've analyzed and classified the open, but so what? What does it actually mean for our trading? In this final section, we'll see how to use that IB classification to actually anticipate how the market is likely to behave for the rest of the day.
What's so amazing is that the predictions from these IB types are often polar opposites. A narrow IB, a quiet open, it's like a coiled spring. It tells you there's pent-up energy and there's a high probability of a strong trending move later in the day. But on the flip side, a wide IB suggests the market already made its big move early on. The odds of another big push are low, so we should probably expect quieter back-and-forth trading.
So here it is. This is basically your strategic playbook based on that first hour. If you see a narrow IB, you're on high alert for a breakout for a potential trend day. With a moderate IB, the day's a bit more balanced, but a break of that initial range can still kick off a really solid move. And if you get a wide IB, the whole playbook flips. A big trend is really unlikely, so your focus should shift to range-bound, rotational kind of opportunities. And that quote really just brings us right back to the core idea of this whole method. It's not about finding some magic setting that works forever. It's about having a process to constantly listen to the market's unique rhythm, its volatility, and tuning your most important tool, your chart, to be perfectly in sync with it.
So I'll just leave you with this final thought. If within the first hour of every single day you have a data-driven framework that gives you strong clues about whether the day is likely to be trendy or choppy, how does that change the way you approach the market? How does that change the strategies you use, the trades you take, the confidence you have? That right there is the power of moving from chaos to clarity.